gotta leave your money behind.
Welcome back to Give Me Some Truth. Today we're talking about an exciting topic. We're going to try to make it exciting as best we can, Syl and I. The strength of the dollar. We realize that this is not something that people generally wake up in the morning and think to themselves, wow, I really wish I listened to a podcast about the strength of the dollar, but here we go. It's important because of the, I would say the events within the last, month/year to date, right? So is that kind of a fair way of defining it? I think ultimately we try to come up with topics that are timely, and unfortunately, in some cases, we don't get to choose how exciting those topics are, but it doesn't mean that they don't have a large impact on the economic decisions and the events that are happening, right now.
Yeah.
And so I think that in the slippery slope that is getting lost in the weeds of a topic like the strength of the dollar, we're going to try to keep it higher level and try to keep it a little bit more pragmatic in terms of what it means for corporations, i.e. what it means for the markets, and less about a theoretical discussion of is a strong dollar better than a weak dollar. I'll first start by saying that for those that are not familiar with this topic, there's no such thing as one is good and one is bad.
Sure.
Right. Is that a fair statement? So
I think it's very fair. There's pros and cons to, either scenarios really.
Yeah. A strong dollar has good and bad. A weak dollar has good and bad. Ultimately, I think what we want to talk about is, what are those goods and bads, right?
Sure.
And kind of why is the dollar strengthening the way it is right now?
Yeah.
And ultimately, what impact does that have for people on portfolios?
And that's been one of the great stories of this year so far, right? So there's a lot happening in the world and a lot happening in markets. And really the strength of the US dollar has been one of those great stories. And when we talk about the strength of the US dollar, we compare it to other currencies from around the world, right? So in particular, other developed market currencies like the yen, the euro, the British pounds, the Swiss franc, Swedish kroner. And if you compare the conversion rate now compared to what it was even, at the beginning of the year,
right,
the dollar is about 15% stronger than it was then. So really, it's been one of the great success stories as far as as positive returns this year has been just that strength in the U.S. dollar versus other developed market currencies.
Yeah, let's talk about that just for a second, right? Because I want to not try to be elementary about it, but at the same time, make sure that we don't lose people in the first 5 minutes, right? So when we talk about the strength of the dollar, right, it's a comparison.
It's a comparison.
That's what we're talking about. And we're using the U.S. dollar as the kind of the base currency.
Correct.
And that's not because we're, egomaniac Americans. That's because the world has kind of looked at it and said, we're going to use the US dollar as the kind of the measuring stick. Right. And so then it's kind of what is the pound doing against the dollar? What is the pound doing against, or excuse me, the euro doing against the dollar? However, if we get deeper into the weeds, which we promise we won't, there are other comparisons, right? I mean, you can just as easily compare what is the pound doing to the euro or the pound to the yen, right? So, I mean, we can go down those paths, but primarily people stay within the, what is the US dollar doing in relation to ... And
you're right. The US dollar is a standard. It's a measuring stick. And we can talk a little bit about why that is and what that means in practice. But it's the most important currency in the world, right? Simply put, not just because we're being patriotic or whatever. It's just, it is a fact, right? And you can ask someone in any country around the world, what is the most important currency for the economy as a whole? And it's the US dollar. The US dollar is, and it's a big part of why it's so strong right now, is because the US dollar is the world's reserve currency. It really is a standard, not just for you and I, trading in goods and services every day because we live in the US, but it's also a standard in commodities trading, for example, around the world. So a lot of raw materials are exchanged using US dollars, even outside the US. So
yeah, let's draw that back. Let me jump in just for a second. Take lumber, right? Because I think everybody has a pretty good feel for the housing market and how crazy that's been over the last couple of years, right? And a lot of that is driven by the cost to build a new home, right? And so we then that bleeds into the commodities market because we're using lumber as an example to build homes. So therefore, the cost of lumber, therefore the strength of the dollar to buy that lumber, right, that all kind of plays into this.
Yeah, absolutely. And so, in the same way that you can compare the price of the dollar to the price of the euro, you could compare the price of the dollar to the price of oil or lumber or any commodities. And that's another ratio, really. Ultimately, these things are all just ratios, just comparisons. And so the dollar, but the role of the dollar internationally is not just limited to commodities trading. It's also the standard in capital markets, right? So there's a lot of international issuers of bonds, of debt, that use the dollar to borrow. So people outside the US borrow money in dollars, right? So that's true of governments, in particular emerging markets, but not only. And that's true of foreign corporations as well. The dollar is also the standard when it comes to foreign currency reserves by central banks around the world, for example, right? So if a central bank in an emerging market country, for example, wants to be to project financial strength and stability, it will diversify its currency reserves. So it will hold not just local currency, but other currencies as well. And as they are trying to do that, the dollar is really a pretty significant factor as they try to secure their financial situation.
Sure.
So the dollar is more than just, our domestic currency as Americans.
There's the role that it plays.
The role that it plays in the global financial system.
So just recently, Microsoft, to kind of, again, drive this into a more kind of pragmatic area so that people have a better understanding of what this means for them in their portfolio. So Microsoft just downgraded some forward-looking projections. And they did that because one of the reasons why they did that was the strength of the dollar, right? And so obviously that is a national global corporation, right? So help the listeners understand why that relationship between strong dollar and Microsoft looking at that going, shoot, okay, now we got to downgrade because of this. Why is that?
Yeah, and so going back to your point earlier about the strong dollar being good and bad. One of the ways that it's bad is that it makes products denominated in dollars more expensive for the rest of the world.
Sure. So somebody buying an iPhone, for example, or a Microsoft product, to stay on that same theme. In wherever, pick the country, in Scotland. Right, they're going to pay not theoretically, but actuality, they're going to pay more for that today than they would have a year ago.
Exactly. And so it's a real problem if you're trying to export goods, right? So it makes your exports less competitive.
Gotcha.
Right? So, and Microsoft's just one example, but really any company, even a small company that is trying to sell goods or services outside the US would find themselves, potentially all else equal, would find themselves less competitive because of the strengthening currency.
And likely have lower profits over that period of time as a result.
As a result of reduced overseas sales, for example, business loss to competitors in potentially countries that have weaker currencies.
Sure. But to that same idea, it doesn't have as big of an impact then on kind of U.S.-centric companies. So companies that only operate in the United States, the stronger dollar is not going to have as much of an impact on that.
It's not going to have as much of an impact. There's always a knock-on effect, in different parts of the economy. So indirectly, you could still be impacted.
Sure.
But it doesn't have as direct an impact.
Sure. what does it mean more in a kind of less portfolio driven and more kind of lifestyle scenario? What does it mean for people traveling?
It's great. if you're American traveling, it's awesome. Your global purchasing power has gone up tremendously. Right. And
so if you were going to plan a trip to Europe,
go crazy.
Go right now.
It's gotten a bit cheaper. Look, and it's not always a kind of, you don't always get to realize all the gains. Because, there's always other things. Like, for example, a weaker currency might have implications in terms of higher inflation and things like that. So you might get to find that maybe the currency has weakened 5%, but prices have gone up 2% or something like that. So it's never a dollar for dollar gain or euro for euro gain. It's always a bit more nuanced than that.
Right.
But in general, you're right. It's one of the benefits is that it increases U.S. consumers or investors. It increases their global purchasing power. So, and likewise, going back to your company, corporate example, it hurts you if you're trying to export. But if you're trying to import, it's an advantage for you.
Yeah.
Right.
Right. So, again, going back to the Microsoft example, if take for example commodities that Microsoft needs to build its products, right, that they get from overseas.
Yeah.
Okay. So that's going to help them in that scenario. So if they're buying X commodity, they're going to. It's a better scenario from there. But selling the final product overseas when they're done building it is now going to be a negative.
Exactly.
Yeah.
And so that's why it's going to impact different companies differently, because they are all getting different goods from different places and then selling them in different places. Right.
So I had a conversation with a friend of the firm a couple of days ago in anticipation of this podcast, and the thought was, the strengthening of the dollar, is that is that because of the dollar itself, or is that because of how poorly all of the other currencies in the world that it gets compared to? Not all of them, but a lot of the bigger ones, the developed ones, as you're suggesting. Is that an indication of their weakening, thus strengthening the dollar, or is that an indication of the dollar more or less kind of did this on its own, if you will? Right?
Well, I mean, it depends on your perspective, right? All currencies, if we think about it, if we put our investment hat on here, all currencies are pretty bad investments, really, in and of themselves.
Sure.
So, I mean, all currencies tend to do a pretty poor job at being stores of value.
Sure.
And, they tend to depreciate over time and they get inflated away. So, in some ways, we can measure currencies against each other.
Right.
Is one fundamentally more sound than the other, and is one really that awesome that you need to put all your savings in it?
Right.
Probably not.
Right.
So it's really a question of what you're measuring the dollar against, and in this case, we're measuring it against other economies that have gone through the same challenges as the U.S. has, and have followed generally the same, very similar type of paths in terms of their central bank policies and their interest rate policies and things like that. So, in some ways, they're all equally bad, and the dollar is maybe a little bit better. But what's really interesting is that it really is better just because of its reserve currency status.
Just because the fact that it is blessed with that distinction.
Because it's special.
Exactly.
If you looked at, because normally if you want to assess the strength of a currency and how attractive it is, right, you would look at measures like a country's trade balance. So the ratio of how much is that country exporting versus what it's importing.
For the reasons we just talked about.
Yeah. Right. So you would say, okay, is this a country that consumes more from abroad than it is exporting?
Yep.
If you're a country that sells a lot of goods, exports a lot of goods, export maybe more than you actually consume from abroad. Maybe you'll have a great trade surplus.
Sure.
That's in principle, that's great for your currency because effectively you're accumulating wealth.
Right.
And that just, there's a bunch of positive things as a result of that.
Right.
You would look at measures like the current account balance, which is effectively just your trade balance plus a few other items such as dividends you receive from overseas. You would look at your net investment income position. So it is, and that is the ratio of the amount of foreign assets that a country owns, that is owned by corporations, the government, and individuals, as a percent, and compare that to the amount of assets that foreigners own in your country.
Sure.
And that would be a calculation of your net investment position. You would look at the fiscal health of a country, right?
Right.
If you look at all those metrics for the US, they're not good.
Sure.
They're actually pretty terrible, simply put, right? So especially if you look at the trade balance, we've got one of the worst trade balance in the world, not necessarily in terms of percentage of GDP, but just in absolute terms. And that's because we consume a lot of products
that are not made here.
No, we buy a bunch of products from China and from other places.
Right.
And we buy a lot more from abroad than foreign countries buy from us.
So let's turn for just a second, and this is your fault, not mine, because you went down this path. So we're going to go down this path. Let's talk about the euro, right?
Yeah.
Because I think that the euro is an interesting talking point, and we'll finish on this. Kind of dovetailing on what you said before, right?
Yeah.
So typically, if I can make a generalization, the Northern European countries make more things, right, than do the Southern European countries.
Yeah.
Right. Is that a fair assessment?
Sure.
The Nordic countries in that they make planes and automobiles and a lot, Germany and things. Right. They make things, right? Italy and Greece and some of the other Southern European countries don't make as many things. That's just the nature of what it is. They rely more on tourism and kind of consumption of kind of their history and what they have as opposed to their products that they make.
Sure.
Right. And so with that being the backdrop, right, the idea of the euro had a lot of benefits. And I still remember when the euro was introduced in 1994. So no, excuse me, 96, 97, somewhere in there.
Late 90s, yeah.
Yeah, right. And the idea that okay, this is going to be great, and people are going to be able to go from train stop to train stop and not have to convert money and do all the things, right? But you and I had a conversation about why this might not be as good, especially going through 08, 09 and through some of the ugly times, all being tied together, right? Doesn't necessarily always produce positive results.
It's a challenge for the EU because they have very different economies, as you pointed out. And so, and this is an important point, is going back to the example about exporting goods. It's easier if your currency is weak, right? So weakening a currency is actually a competitive advantage.
And a government actively trying to do that, right?
Yeah.
Through monetary policy and things like that, right? So the government has the ability to turn that dial a little bit.
And it's not just hypothetical; they do it all the time,
right?
So governments, central banks, they try to weaken their currencies, and especially a typical example would be emerging markets, right? So they are basically just in the business of many of them of devaluing their currencies in order to get a competitive edge.
Sure.
And oftentimes if you have a weak economy, maybe it's structurally poor for various reasons, then you try to get an edge by devaluing your currency.
Right.
And so typically, all else equal, if you have a weak economy and you're trying to stimulate it, you want to benefit from that weakening of your currency because effectively it starts a cycle that allows things to self-correct effectively.
Sure.
Right. In Europe, they don't really have the luxury to do that. They don't have it at all
because of the euro.
Because of the euro. So in a way, the monetary policy of Greece is tied to that of Germany.
Right.
Now, Greece and Germany are two very different economies, two very different countries. very different profiles, but yet they are glued together.
Yes.
As far as their currency. And it's one of the many challenges that the EU is facing. They've obviously done a lot of good things, and there's mobility of labor, mobility of goods,
Right.
and all of that helps that cohesion.
Right.
But it's not perfect.
Yeah, it's the idea of, and is a simple analogy, but the idea of if you've ever tried to order pizza with 8 people in the room,
Yeah.
right? Okay, that simple idea creates problems. And so
Yes.
the idea of trying to say, let's take multiple countries that have multiple profiles, economic goals, economic structures, and let's require them to all use the same currency, therefore tie them together in a way. So if you go back to 08, 09, there were a lot of very, very smart people that thought if Greece still had its own individual currency, right, then they could have what? I mean, they could have more or less.
They could have devalued it.
Exactly.
They could
right?
have inflated away some of their
Yes.
debt. They could have tried to, revive their manufacturing base by making their exports more competitive.
Right.
That option does not really exist.
Right. Similar to what Japan did, correct me if I'm wrong, in the 80s, right? The Japan kind of.
Sure, after they went through a big crisis.
Right.
Yeah.
And so they kind of used this, as you said, they knew that the end result of it would be a self-correcting, outcome. However, very painful to get to that point, but
Sure.
potentially necessary, right? And Greece didn't have that option. Italy didn't have that option. Spain didn't have that option at that time because then the effect of that would have the same result in Germany and in the northern countries.
Exactly.
So there's talk that we may see the euro go away at some point.
Well, I mean, I think so much has been invested in creating the Eurozone and making that a relative success that I don't think it's going to go away anytime soon.
Right.
But there will be pockets of, challenges in different countries where you're starting to see on the political front, you're starting to see, very nationalist candidates that have a platform that is anti-EU.
Yep. And this is what we saw in the UK, correct?
Exactly. So you can see in the UK never had the euro, so they didn't have that issue. But if you had similar type of political momentum in a country that actually has the euro, you could very well see that morph into a kind of not just anti-European in the sense of being anti-EU, but being anti the euro.
Right.
We want to revert to our, currency from the 90s because, life was so much better in the 90s. So if we just go back to that currency, then life would be good again.
Right.
I think those discussions are happening in one form or another all around Europe. I think we're not quite at the stage where, they're going to happen like very soon. Right. But who knows, like 5 years from now, and, part of the strength of the dollar is, again, the weakness of the euro, right? So if the euro continues to depreciate and if there's political challenges in different countries around Europe, I think you could see that anti-euro ideology really gain a lot of momentum.
Yeah, because in that example, it's almost like a teeter-totter, right? The person on the left side, the further they go down, that means the higher the person on the other side goes up, right?
Yeah.
Even if they don't want to, right? So if the euro continues to devalue, that does nothing but push the strength of the dollar higher.
Mm-hmm. Absolutely.
Yeah. And I think the interesting times that we're in right now, and I think the listeners have heard us talk about the fixed income market, the bond market before. You and I have had conversations about this. I think that all of these are just characteristics of a very, very unique year, that is 2022.
Yeah.
Right. I think the start of this year has put things in front of us as money managers and as investors, as our clients are, that we can't say we've never seen before, but wow, it's been a long time.
Yeah. And it is. It's been a bit of a crazy year, and the dollar strength is part of that overall picture. And I mean, what's really interesting is, I mean, you think, okay, the U.S. economy is facing challenges. Rates are going up. There's inflation. Now people are talking about recession. The dollar should weaken, but it doesn't.
Right. That should be the result, right?
The dollar strengthens.
Right.
And what you tend to find is that the more uncertainty there is, the more chaos there is.
Right.
Actually, that tends to benefit the dollar. And the reason for that, again, goes back to the really special role of the dollar in the global economy.
And the thought that it's, quote, safe or safer, right?
It is safe, and it is, and even
stability, maybe not safe. There's a stability to it.
And I would go even beyond that in the sense that it is that people need to get their hands on it. So, I mean, it's a very practical thing. It's not just, there's chaos, I feel safer getting dollars in my account. Is that there's trillions of dollars worth of dollar-denominated debt issued outside the U.S. All of that debt has to be serviced.
Right.
Interests have to be paid. There's trillions of dollars of commodities trades settled in dollars every day all around the world. And you need to come up with dollars to do that. And so when trade flows are strong and, there's profits are strong, there's plenty
liquidity is strong.
And liquidity is strong.
Right.
There's plenty of dollars to go around.
Right.
But when things get tough, suddenly there's a shortage of dollars.
Yeah.
In overseas markets in particular. Because it's very easy for central bank, for the Federal Reserve to push dollars into the U.S. financial system.
As they've done over the last 5 years.
They've done a lot of that.
To an unprecedented level.
Incredible levels.
Right. And
they basically put capital back on banks' balance sheets, and they recapitalize the banks, and they build up bank reserves. And they can do that very, very easily. But it's much harder for them to push dollars into every corner of the global economy. Actually, there's very few mechanisms for them to do that. And so what tends to happen when there's a lot of uncertainty in the global economy is you see this scramble for dollars, in particular in overseas markets. And there is literally a shortage of US dollars, as amazing as it sounds, despite the fact that our monetary base is larger than it's ever been. What you tend to find is there's actually a shortage of dollar globally. It's as if you could not print enough dollars to go around. It's pretty incredible. But
thus strengthening the dollar.
Yeah, and so and all of that contributes to the dollar being stronger as chaos, so to speak, is increasing.
Right.
So even though the U.S. economy and the U.S. as a country faces a lot of challenges, the dollar keeps getting stronger. And I think it's a good thing in many ways. And as we said, it increases our global purchasing power. And in many ways, it almost allows us to live beyond our means.
Right.
In many ways. It allows us to borrow almost endlessly as well. All of that is good. But it's also a challenge, I think, long term. Because again, it makes our exports unattractive, and so it doesn't allow this self-correcting mechanism that I mentioned earlier, which would normally involve a country having a very poor trade balance, seeing their currency weaker, which would then lead to economic stimulation, stronger manufacturing base, higher exports, and kind of the cycle correcting itself.
Right.
In the U.S., it works almost in reverse. Because we are the world's reserve currency, we almost need to run a big trade deficit. And it doesn't correct. It actually is kind of just getting worse all the time.
Which, in a way, and we'll end on this, I think is the reason why, or is more evidence why the Fed has some challenges right now. And trying to figure out what to do, and understanding that even though they have, whatever, a dozen different buttons in front of them that they can push, there's trepidation by pushing the wrong one or the wrong combination of buttons at the wrong time. And all of a sudden, oh boy, this went left and we thought it was going to go right. And now we have a problem.
Absolutely.
Yeah. Well, I hope people got something on it. I know it's a heavy topic, but we thought it was an important one simply because of what's going on right now. We would love to hear your comments on it. If you listen to the podcast and you have thoughts on it, feel free to email us or send us a message. And if you'd like to hear more about this type of topic, let us know, and we'll be happy to do it as well. So thanks so much for your time, and we'll look forward to seeing you in another episode of Give Me Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.